Welcome to the Cashbox Global Information Session, where we're going to be discussing our latest capital protected income structured note. And for the newbies, my name is Jill and I take care of the investor community, and Andrew is the brains behind the note and is our technical specialist, with Chad and Logan helping us on the operational side to keep all things going smoothly. Please feel free to post your questions in the chat as we go along. And for those that are new to structured notes and have any questions, just let us know and we will set up a time to do a coaching session with you. So with that, as usual, there's always some housekeeping when it comes to financial services. So a reminder that we do not provide financial advice. The session is to introduce you to the structured note and explain how it works. We always encourage investors to make decisions based on your own research, and if needed, get the advice of a licensed professional that you choose. For our full disclosure information, it is on the website, and you'll also be able to find more information on structured notes, as well as active and matured products that you'll find there as well. So with that, I'd like to hand over to Andrew.
Thanks very much. There we go. Back to that first slide. I'm just going to make it a bit smaller. Yeah, I've got the Matt, why I mentioned that was that I was looking at the weather in the UK because my daughter, who's been out here for a month for my eldest daughter's wedding, the other daughter's now going back to the UK, and she's dreading going back to cold weather and shortening days and lengthening nights. But anyway, we've got a farewell dinner tonight. So they've all said, don't speak forever. Get to the point. So I think, yeah, let's have a look at what we're looking at here. It's a income note based in US dollars. It's structured on a semi-annual payment payoff structure. So twice a year, 15.2% per annum. I want you to hang on to that because in the rationale that went out, as well as my weekly wrap, there's been a bit of anomaly in pricing in Europe recently. It's all sort of reverted back to where it should be. But I think our timing, and hence my comment earlier to Graham, our timing was absolutely spot on with us in terms of securing a coupon return that's not generally in this sort of space for a defensive type of sector. Having said that, it's a defensive side of the sector. I'm going to blow your hair off your head just now. And I'd like to point out the bottom corner block, closing Thursday, the 18th of September. We've had enormous take-up on this note. Obviously, we mentioned about a week ago, 5 or 6 days ago, that the note was going to become available. It's taken quite a lot of arm wrestling with the bank, negotiations through IDAD, our structure, with BBVA, who's the underwriting guarantor of this contract. And quite frankly, we took advantage of, and it's all mentioned in the sort of the rationale, of the recent turbulence in French politics, which some of you may have followed. I find politics generally quite confusing, particularly if it's in a foreign language, never mind the Americans. But safe to say they lost the prime minister and they've got a new prime minister as of, I think, this morning. But it's heaped a lot of pressure into the French space, a political and economic space, and they're a big part of the EU. They're a big part of the system, the systemic banking system, the systemic economic system. So everyone's watching this quite carefully. I think just briefly, everybody knew the French were going to get a vote of no confidence. I spoke to a friend of mine who lives in Paris, and he says they're going to get a vote of no confidence because this guy's projected that they should lose 2 public holidays. So never mind their pension funds that are going to be affected. They were more annoyed about the fact that 2 public holidays were going to be taken away, and they were told to be more productive. Be that as it may, it's an unfolding story. The pricing has moved back to kind of where it should have been, but we were literally in a tactical position, very much like a note we produced just after, well, during COVID, with oil, when the world stopped and there was so much oil, and we took a note on oil. So this is a sort of a tactical opportunity, 15.2%, great opportunity. I have to take my hat off to our structurers who really pulled the rabbit out the hatcher. It's got all sorts of, as Jill calls some of the folks out there, newbies and new people to the adventure in structured notes. It has a lot of verbiage there, 60/50 memory income call reducing. We'll go through that later. So just understand this is an income note. It's in US dollars, pays twice a year, subject to T's and C's. And we've linked it to, it doesn't say here, but we've linked it to one of our most successful themes. And Cashbox is a thematic company. In other words, what I mean by that is that we follow resonant themes that make sense both now and have longevity into the future. That it's not a fad. It's going to have the earnings potential and the growth potential within its own economic sector to carry it through for a number of years. So what I'd like to do now, if we could move along, is just introduce you. It's a banking themed note. Okay, and the preponderance of weight has been allocated to European banks. Okay, there is an American bank in there, Morgan Stanley, one of the heavyweight titans of Wall Street. And some of the names there you may be familiar with in terms of the European banks, being Barclays, which is pretty much as a sort of household name effect. UniCredit, to many people, is, unless you're living in Europe, second largest Italian investment and commercial retail bank. Probably the way it's going, and we'll get to that later in the presentation, it could very well become the biggest bank in Italy and probably one of the biggest banks, certainly in the top 3 or 4 in Europe, if their aspirations of consolidation and takeovers happen. Very aggressive bank. And Commerzbank, which is the second largest bank in Germany, bank to the German government and to basically the middle sector of Germany's economic machine, which is basically, Germany. That's what keeps their economy going. BBVA, the guys at the top, are the underwriting bank. They're the guarantor of this contract. They're the issuer, so it comes off their balance sheet. 15th or 16th largest investment bank in the world. We've had a long relationship with them. And some of the arm wrestling that Graham's undertaken has been because we've got great relationships with them. We've used them in the past. We have a good working relationship with them. They know when we come to the table, we're serious, and they treat us, I think, with a lot of respect. And we're very grateful for IDAD and our working relationship. So these companies are actually dealt with in terms of the granular stuff. We don't own these companies in the note. As always, they're a reference basket. So the theme is European banking. 75% of this is weighted towards Europe, with a smaller percentage towards the United States. So why Europe? I mean, this is the whole question in terms of we've had a number of notes, and I think if we go to the next slide, you'll see exactly matured banknotes. So 13 or so, I think, if my math does, my eyes do my math correct. The most recent one was on the 1st of September. So if you can make out the numbers, it is quite small. The actual duration, I think, is quite an important factor. Many of these notes were launched 2021, 22, 23. We've launched right the way, literally, post-COVID, right up until we've had launches this year. So the question has always remained in our mind is this a winning sector, and how long is that winning formula going to remain in place? Because that is important. I mentioned earlier, we launch notes that are going to have a thematic impact both now and in 2 to 3 years' time, if they happen to run that long, because our contracts are normally structured for a 4-year period. So within that time frame, there has to be a correlation of the theme working within the economic cycle. Okay. So you'll see a lot of those lasted 6 months, 9 months, 12 months, etc. And if you add up, if you do the per annum sums, if you can see those small numbers, generally speaking, you're looking at a 12 to 14% per annum US dollar. Some of these have been different currencies, but let's use US dollars, reference to the current note. You're looking at a note that doesn't rival some of the technology, sort of AI, semiconductor, microprocessor type of fizzy type of issuances that have been put out there, where the coupon payoffs, depending if it's growth or if it's income, would be at a much higher level. So suddenly we've come up with a banking theme with 15.2%. Where does banking come in, where we've suddenly upped the ante? We've really pushed the envelope here in terms of getting the right coupon, or a fantastic coupon out. Again, I mentioned thanks to our structurers. So it's a sort of situation of, it has been working for us as a company and for our investors and our community very well. Question really is it still relevant? Is there a disconnect in terms of it's all going to fall out of bed? And that's really what the rationale deals with, and that to a large degree is what tonight deals with. So this is a bit of a slide that hopefully will grab your attention. So this is actually ex-Reuters. This was produced by Reuters, not specifically for me. I wish I was that important. But if you were an investor and you'd bought into the European banks sector, in other words, there's a sector, there's an ETF that you can actually buy. Okay, if you bought this 5 years ago, you'd be sitting on 243% return. You can punch it into your phones. You can do the homework. I did it to make sure it was correct. Versus, okay, so it's a specific sector. It covers a number of different systemically important European banks, not UK, it's ex-UK, and 243% return versus 51% for the broader, what's called the SOX 600. That's the 600 most important companies throughout Europe, going right the way through all the different geographies, France, Spain, Belgium, etc. Okay, ex-UK again. So where does this come from? And if that doesn't work, if that doesn't grab your attention, have a look at this. Okay. We all get sort of myopically obsessed with the US. It's the biggest economy, it's the biggest market in the world. And suddenly we're looking at indices, the S&P, the NASDAQ over the same 5-year period. And you can see the results on screen. NASDAQ, 115%. Okay, so I'm not taking a micro sector of the NASDAQ. So the NASDAQ covers all those companies that are linked to technology, communication, etc. So it's a much wider spread. But it just gives you a comparative sort of feeling of how strong this banking sector in Europe has been, and it's been fairly unheralded. Everybody talks about, what's happening and what's fueling the market in America, and it is the biggest market. And if it does catch a cold, we sneeze and all the rest of it, we know that. But quietly and just in the background, the European banking financial system has re-engineered itself and has suddenly come out with these stellar reports, very quietly. And so who would have thought, as per my point at the bottom, this boring sort of banking sector would outperform the fizzy sort of investment darlings that is tech, etc. And the analogy I drew in a presentation this morning to some Australian clients was, the tech, the high performance, quick moving, very fizzy sectors is a little bit like a speedboat. You can make a wrong turn, it'll flip. There's a lot more volatility, there's a lot more action, but there's a preponderance for things potentially to go wrong quicker. Whereas the banking sector, and it's pretty much a global, I suppose this is a global brushstroke, is a little bit more like a super tanker chugging along. It takes a long time to stop, it takes a long time to move left or right. It's part of your DNA, it's part of the social fabric of a country, of a region, and in some instances, it's part of the global system. So that really caught my attention, and I double-checked the figures from Reuters, and this is the sort of thing that AI produced, and I thought to myself, it's quite fun, because how the heck did this happen? How did this happen while we were awake or not sleeping? And it's sort of a bit like Cinderella went to the ball. The banking sector went and made money. And is Cinderella still out? And is the banking sector still out there? So to my point earlier of making the comment of, is it pertinent? Is there still a correlation to current matters, current geopolitical headwinds, everything that's facing us? Does it still make sense to be in the sector? Or have we passed our purple patch and we're over it now and we're getting into the tail end? So like Cinderella, who's still out and hasn't come home yet, the banking sector is pretty much out there. And there's some very compelling conviction by some very sage parts of the community, the investment community, that sort of point to carrying on supporting this area. So pain can stay with us for a long time, and we often forget pain very quickly, but let's just have a bit of a history lesson here. So I'm not going to dwell on it too long, because we've all been there, we've all been through this. So the global financial crisis and the pandemic, there's two little circles on that chart there. The one, it has to be bigger because it was obviously a bigger event, quite frankly, in terms of economic cycles. And that's the 2009, 2010, what was called global financial crisis, where banks literally got themselves into a corner, and many of them failed. It caused a global meltdown. It affected all of us, whether your pension fund, your investments, your day-to-day living, everything was affected. That's the big circle. The smaller circle further along down the line, down the timeline, is 2010, the pandemic. We've all been through that. But just by way of illustration, you can see the difference in terms of scale and scope. I mean, we all thought we were going to die, certainly, physically in 2010. I beg your pardon, 2020. No, certainly 2010 probably had the same effect. But 2010 was drawn over a much longer period of time. That decline, in which I did the actual maths, the decline was around about 82%. That's massive. Hence the fact that the world had to reinvent itself in terms of its financial systems and its financial markets. But that was about an 83, I think it was correct, 83.6% decline from the top, okay? But it happened over nearly a 2-year period, okay? Whereas further down the line, that happened in the space of a month. Their loss was probably around about 30, 36%. So much shorter, much sharper, but the recovery thereafter you can see moving off to the right-hand side. What's important to me for this presentation is what happened really in the lead up to that big bubble, 2010, the global financial crisis, the GFC, and what happened between that point, the low point, just for 2010, and how it sort of meandered along up until 2020, where the banking sector was pretty unloved. It wasn't a sought-after sector. It was reinventing itself for a number of different reasons. The two major events that made that long sort of static line up until 2020 happen was the global financial crisis. And about 2 years later, there was the sort of the leaders got together and they realized they were in great difficulty in terms of debt. Okay. And nothing really happened in terms of them economically fixing things. Okay. But it was up to them. What they did is they imposed regulations on the banks, and we'll get to that shortly. So there was a lot of hard work, a hell of a lot of hard work, that the regulators, after suffering that massive collapse in the GFC, the global financial crisis, they said, we've got to get things right. So a lot of work happened kind of behind the scenes. It was like Cinderella sweeping while everybody was out. Nobody really noticed what was going on. And if we move to the next slide, Jill, if you may. Pretty much what happened was a lot of the scars had to be repaired. And one of the big issues was selling off bad assets. The banks had taken on these toxic assets. They were full of them to the hilt. Many, household names collapsed. And essentially the regulators came in and said, sell off this toxic stuff, sell off the bad assets. You've got to raise cash. You've got to build your balances. You've got to build your balance sheets. You've got to protect your customers, your shareholders, and your staff. I don't know what order that should be. It should be staff first, I think, but ultimately, I think they look after shareholders and then investors. And you can see there from 2010, the arrows, it was kind of declining. 2006, 2007, it was going down. Life was easy, not too much regulation. The banks were writing huge checks for their leadership teams, obscene checks. I was working in investment banks at that time in the UK and Switzerland, and it was really obscene. And we all know what happened, obviously now in 2010, and the banks basically had to wind their head in and literally had to reinvent themselves, reorganize, deleverage a lot of their situations, get rid of the toxic stuff, etc. So when 2020 came along, and why I've circled that, is that, sure, if you think about the previous slide, there was a big blip down, we all remember it. Economically, it was 3 weeks of absolute chaos and panic. But look at the line to the right. The asset ratios remained high. The cash balances remained high because they'd done the hard work. That was the period where European banks quietly got on with getting their house in order, if I may call it that. And so when 2020 came along, I won't say they brushed it off. I used that expression this morning, and that's perhaps a little cavalier. But they were able to absorb the shocks and the impact of what it meant. No banks went under. No banks collapsed. Okay, that was all from 2009 and 2010. Life, to a large degree, carried on. we all were into a new space in terms of how we acted, behaved, communicated. Everything was changing into the digital space. But from the banking perspective, they'd survived. They'd gone through it. They hadn't gone through the drama that they'd faced in 2007 when things started going very badly for them. So if we go to the next slide at the same time, okay, this is a chart, and I don't use a lot of charts, but tonight they sort of make sense. This again sort of says what happened on the left-hand side in 2008, 2009. We had this, deposits, collapse, okay, because people were taking their money out of banks and banks then collapsed, okay. And as you can see, this is a look at how interest rates and deposits work, because generally speaking, when interest rates are high, people stick their money into bank account. If they are, if they're cautious of the stock market or other investments, if they say, well, I'm getting 6-7% in cash, that's fine. I'm happy with that. That suits my requirements. Okay, but you can see what happened there. It came down. You were earning just pretty much nothing. And then in 2012, when the EU had its debt crisis, some countries went into what's called negative interest rates. In other words, you were paying the bank to keep your money. Switzerland was a very good example. We're safe, we're Swiss, nothing can go wrong. We have cuckoo clocks and chocolate, and you will pay us now to look after your money. Okay, so it did happen. It happened. Japan was another one. Okay, not in Europe, but it happened all over the place. So what happened from an investor's perspective is that, sure, you weren't earning anything, and in terms of inflation and cost of living, you were going backwards, okay? But this was the period, the 2011 right through to 22, where the banks were reinventing themselves, okay, with interest rates, volatility, and deposits. And funnily enough, deposit rates were actually increasing as we approached that period. So 2020 came along. I haven't marked it as a significant effector because banks were already at sort of 0.5% minus deposit rates, etc. And the Europeans, like the Americans, like the Brits, pretty much globally, even in South Africa, they were cutting interest rates to keep businesses' heads above water, to keep people, to keep their homes, etc. So it was a tough, tough time. But obviously what that spurned was lots of fast and loose money flying all over the place. They were printing money. Global quantitative easing was the big word. Basically, governments were saying, have money, spend, try and get the economies going again after those lockdown periods where the economies went into a sort of a gridlock. We all know what happened. Growth went mad, okay, in certain areas. The new world as we were living in, the technology world just took off, and those sectors did extremely well. Interestingly, Cashbox's evolution, we talk evolution here, was 2019. Chad and I went over to Mauritius in 2019. We came back and we said, this is a brilliant product. This is a brilliant solution. We've got to democratize this for the world. And we started Cashbox. And we've grown a fantastic family of friends and colleagues and communities. And they've been on this roller coaster in terms of what's happening in the world. I'm not going into some of the other aspects which are so important in terms of what we've had to face during those times of wars, of inflation, all those headwinds that we've literally had to box with, but very successful, and banks have been very successful in this sort of infrastructural space. So you can see end of 24, this is the EU sort of setup, rates plateaued out, and then they came down quite sharply. Very different to what's happening in the States, although next week we're going to get the announcement, and it looks as though there's a big debate now. There's going to be a cut. I think it's on the table in terms of the latest data points in jobs and employment. I think it's there. The big debate is now, is it going to be 0.5% or 0.25%? Or will it be 0.5% and then wait, or would it be a series of 0.25%? So there's an obsession about interest rates in the United States, and probably rightly so from a world perspective. But they've come down sharply, okay, in terms of the EU. So it's been quite predictable. Banks have been able to look at this saying, we know what's happening. We can factor in what our loan book is looking at. Are there bad loans? Can we make provisions, etc.? It's been a very stable step-down effect. Whereas in the States, I won't say the Federal Reserve has kept everybody hostage. They've probably done the right thing, I believe, without even with the pressure coming out of the White House to lower rates. They've said we need to understand what interest rates, inflation is doing, and more recently, what is going to be the uncertainty that comes out of what's the certainty that comes out of the uncertainty around tariffs. So in terms of growth, etc. So they've been sort of stalled for the whole year. They haven't had an interest rate. They're only, I think, 0.75 off their high at the moment, whereas the EU is all the way down to sort of 2% and may go further. Europe had to do that because they were more stagnant. And this next chart is really, really interesting. So this is the American bank, the equivalent peer sector in the States versus this wonderful 243% or 246% return sector. So many of the South Africans will be familiar with a very famous speech made by an erstwhile prime minister, where the phrase was coined, crossing the Rubicon. In other words, a fundamental change has happened, a step change has happened. And that was in 2003, where the European market, which is the European banking market, which is the brown line. As you can see, the brown and the brown and the blue is the American. They kind of work in step lock together. It's almost a mirror image. But then there was a convergence, 2023. It was in the Biden Democratic period, and it's crossed the line quite strongly. It's come back more into a sort of correlative sort of space now, but with far less sort of volatility. But they've crossed the line. So the last 2 years, the European banking sector has outperformed, the world's biggest markets banking sector. It's equivalent peer. Now that's quite fundamental. And it's fundamental from the perspective that, I'm not talking, 2023, most people will say, yes, but that was when the Americans had a couple of banks collapse, mid-tier banks. It didn't really have anything to do with that. That was really because regulations weren't controlling from a regulatory perspective. There wasn't a sufficient control on those American banks. The government stepped in. It was sorted out very quickly. And in Europe, there was a bank that also got into major problems, so it wasn't confined to America. That was UBS in Switzerland, same thing. And the Swiss regulator, 𝘈𝘶𝘵, and the government got together and they said, it needs to be sorted out because it's one of the major banks of Switzerland and in Europe. But it was really, I think, that hard work I keep referring to that had been done in a decade. It took over a decade to get to this point. So this wasn't engineered with clever financial engineering or leveraging or 2xing or 10xing something. This was solid, hard graft that took a long time in quite a dull sector. As I said, it's been overlooked for many, many years. And suddenly now, the fortunes have changed and suddenly it's in everybody's global equity portfolio. And we're very thematically inclined. So we love themes. I've spoken about this. We launched a defense note aligned to defense companies and cybersecurity companies. I think it was a couple of months ago. It was fully subscribed in 3 days. It was after this, it was the fastest ever full subscription. We were absolutely blown away relative to what had happened. And we have to thank Donald Trump. He was one of the catalysts. So I think if you see the bullet points that pop up now, thank you, Donald. And why do I say that? Well, essentially, it started with NATO. America is not to be regarded just as the fallback guy, and that they were fed up of paying so much for their contribution to NATO, and that's the fact that Europe had supported Ukraine. Their war chest was empty, the cupboard was empty. They now need to re-engineer themselves, refill the cupboards, and do all those things. So Trump actually made them look inside themselves and say, right, guys, we actually got to do this for ourselves now. That in a way was quite beneficial because obviously you have to fund these particular infrastructural changes and advancements, and that's going to come through the banks. Okay, but it needs to come through a central fund. The suggested and mooted, it's called the European Savings and Investment Union. It's like a central bank, but it's just going to hold money for these infrastructural spends. €1 trillion is going to be allocated to propping up the Western or NATO defenses against the Russian bear, if you want to call it that. And these are all going to be financed. So it's a savings unit, but the actual mechanism of funding these is going to be through investment banks. And it's the big investment banks around Europe. And many of you have been on the calls with me before. We always look for the best of breed in terms of either the underwriting bank or the type of banks that we put into our particular products. You won't find any French banks here because at the time it was too volatile. So we decided no, we'd stick with German, Italian, a German, Italian, American, and British bank. And, we obviously got the coupons paid out of that. So, and whilst this defense note has done, those clients who are sitting in that defense note must be looking at it quite chuffed, it's done very well. But that's specifically niched into the defense and cybersecurity space. Banks are funding that. But this goes across all sectors. So banks fund across all sectors. And if you remember that previous slide where it shows that interest rates have fallen and could fall further, money is cheap, okay? Money is very cheap in Europe now. So whether you're a corporate looking to reinvent itself in terms of, I'm going to take out the competition down the road, whether you're going to refinance your business, whether you're going to have increased CapEx to provide new equipment in your business or your distribution or manufacturing, whatever sector you sit in, you're not paying the bank a fortune. And counterintuitively, you say, well, hang on, the bank's earnings are going to go down. Okay. And certainly, yes, but that is offset because these are investment banks, and this is critical. Investment banks make huge amounts of money out of investments, strategic investments, and providing funding cheaply at this point to mergers and acquisition, to corporate activity. So there's a lot of consolidation currently underway. It's been underway for some time in Europe, and specifically in the banking sector itself. It's a little bit like a fishbowl where only some of the fish ultimately might survive because they keep getting eaten by their bigger brothers or the fellow occupants of the fishbowl. So I mentioned earlier, UniCredit, very aggressive in this space, have lots of targets, building up strategic interests in other banks across Europe, and probably, subject to regulatory approval in time, you'll probably find somebody like UniCredit could be certainly in the top 3 banks in Europe, and then certainly is going to become a household name. Their CEO was named Banker of the Year last year, for example. The Shark of Milan, as he's known, a bit like the sort of Shark of Wall Street or the Wolf of Wall Street. But there's a lot going on there. There's a lot of consolidation. There's a lot of activity, a lot of corporate activity. And it was against this that we thought, well, hang on. In as much as that some of the net interest revenue that you earn out of deposits, you're going to be matched with this wonderful opportunity of earnings coming through the investment bank. And as Graham always said, who's on the call, he says, when you shake hands with an investment banker, count your fingers afterwards because they're always looking to make a profit. So I think what's leading on to my last 2 slides is JP Morgan, Chase Manhattan came out 2 days ago with a note to their clients. One of my family office clients has got JP Morgan, and he shared this with me. And it's quite interesting in terms of how they see the overview of the European banking space, because it's right front and center in terms of where we're at. So if we move to the next slide, Jill, they see it as being in the sweet spot, okay, currently, okay? Yes, we've made a lot of money. The banks have made a lot of money moving up to that, but they certainly see it at the sweet spot. The strong fundamentals, strong balance sheets, valuations, and there's a disciplined capital management. They've got experienced teams now running these banks. They've done the heavy lifting in that 10, 12 years leading up to, well, in fact, it's longer. It's probably more like 15 years. So we're heading for the second decade. And I read this, and I'd like to explain this. It says the expected sector's cost of equity, the typical banking speak, is about to fall from 11.5 today to 10% in 2027, maybe down to 9. So my thinking is like falling is not always a good thing unless it's interest rates and my debt. So I like to see things going north, not south. But as it says there in bold, the trajectory implies a rough 15%, perhaps if you want to call it a discount, or with an upside to the actual pricing, and as much as up to 25%. So, what does it mean by cost of equity? So for the average man in the street, I did an example. So cost to equity. So if you had a cost to equity of, let's say, 10%, okay, so 10%. So in the financials, if you're a financial person, it'll say cost to equity 10%. What that means is a company must generate a return of at least 10%, okay, of its equity finance investments to meet the shareholder expectation. So it's got to match it. So this is very good news then if that 10% is falling down, because there's less expectation, there's less taking on of risks. It's like with a bond. If you go into a company, or if you go into a jurisdiction, a country, And if the bond yields get very, very large, it means there's a risk involved, okay? They've got to pay you that premium to get in there. So if you've got a falling premium like we have here, that's very, very good news as far as I'm concerned, and certainly as far as JP Morgan's concerned. Some of the things that they highlighted: valuation, critical. I'm a big valuation guy. You always hear me going on about valuations. Go down and see how they're making their money, how much debt they're carrying, what is their discount, are they at fair value for their peers, what is the risk involved, all the different risk factors. Valuations are very important. And we saw what happened in America. Some of the valuations in the tech sector ballooned out of, they've, when you get a triple-digit valuation, price-earning valuation, you kind of think, well, there's a lot of risk in there. The valuations of European banks, as mentioned here, 34% discount. I love the word discount, okay? Capital strength, the next point, is another pillar. They've built this capital. That slide showed you. They've maintained fiscal discipline. When 2020 happened, it hasn't moved up and it hasn't moved down. They've stayed the course, something I always suggest clients do. Asset quality, across the pond, as they call it, or it is the pond, not the Gulf of America yet, but the asset quality on European books is of a better quality. Their debt is of a better quality than, let's say, the American peers. The Americans might argue the toss, but I think there's consensus. So certainly, one of the big titans of Wall Street is suggesting this as well. Asset quality is stable. As I mentioned earlier, they can forecast where their bad loans are. So if interest rates are coming down, it's helping those distressed businesses. They're actually having to unwind maybe provisions they had made for bad debt. So things are getting better, even though Europe is slightly stagnant. They've had to cut rates to spur that economic revival in Europe. And despite that, interestingly, people are still putting money in the bank at 2%. And I'm thinking to myself, well, I can get 2%, or if I can get 4%, etc., that's fine. I mean, a German 10-year bond, you'll get 3.5%. Okay, very different to a structured note. Please do not compare it to 15.2%, because you're looking at two completely different products. But the question is that you need to interrogate: would this be part, or should this be part of a portfolio, or aligned to other notes that you're building as a portfolio of notes? And that's when it may or may not make sense to your own particular requirements. So deposits are still growing, and corporate activity is hitting new highs. So banks are still making a lot of money. So there's still that resonance that it's relevant, and I think that's what's very important. This is a relevant situation that's going to carry on for a few years. So the conclusion that I made is this sector is very resilient. 13 notes over a 5-year period. We kind of forecast that the strength is going to remain in place. The super tanker chugs doesn't turn on a right-hand curve, every single day. It happened in 2009. I think the regulations and the safeguards and the barriers, the safety rails have been put in place. If you move away from those safety rails, you lose your business license, your banking license. It's very simple. So the type of companies that we're going with, household names, big companies on the up. It's probably, I think, I'm probably stretching it nearly 2 decades, probably 17 years. But that's a really strong position. And this particular note, as Jill, I think, takes over from here, we're not allowing it to call at 6 months. The first call is at 12 months. So you'd get the benefit if it does go the way that the pundits are suggesting. You'll get the 15.2. It won't mature after 6 years. I beg your pardon, not 6 years, 6 months. And there's a lot more detail in the rationale, and certainly the financial metrics that I dig into are available if anybody wants to kind of sort of look under the hood if needs be. But I think this is where Jill tells you the more exciting stuff than my boring super tankers and speedboats.
Great. Well, thank you. That was really, really interesting. So if you do have any questions as we go along, please drop them in the chat. We will be answering anybody's questions at the end. So as Andrew mentioned, we've got BBVA as the issuing bank. And as he said as well, we only work with tier 1 A-rated banks, and they are the ratings from Moody's and S&P. The coupon, as we said, 15.2% per annum, paying 7.6% semi-annually. The maximum term of the note is for 4 years. The income trigger for this note is 60% of the initial value of those underlying stocks. So the underlying stocks need to be at 60% of their start price for that coupon to be triggered. The autocall this time is actually a reducing autocall. So while it needs to be at 100% of the initial value at that 12-month point, that reduces by 2.5% every 6 months thereafter. So it makes it easier and easier every 6 months for the note to actually mature early. Andrew's gone through the underlying stocks, and there's more information in the rationale about the stocks. Our capital protection that we've got built in here is also at 50%, and I'll run through a graph with you shortly just to show you how that works for those that are new or need a bit of a refresher. Our availability is the earlier of this 18th of September or full subscription. At the rate we are at the moment, we're not going to get to the 18th of September. We have gone back to BBVA to get more capacity because on the back of our invitations, we always say, if you would like to reserve capacity, let us know. And we were quite overwhelmed by the number of people that did reserve capacity. So we've gone back to BBVA to increase it. And we have to go back to them tomorrow morning to let them know how much more we want, and then they will decide whether they're going to give us even more capacity. So please, if you are interested in participating, you need to mail us by tomorrow morning about how much you would like to reserve for yourself. Minimum investment, as always, is from $10,000 upwards, and your dealing ticket and your funds need to be cleared before the strike date, and it needs to be with your trading platform. So just to go through how the note works, I'm going to start by going over the features that are included in the note, and then we're going to run through a quick example. So if you have a look along the top of the slide, you're going to see that the graph is broken into observations. In this case, we have a semi-annual observation with the note paying out the 7.6% after each successful observation. The value of the stocks in the underlying basket are going to be measured on the strike date, which can also be referred to as the strike, start, or initial value. The terms are interchangeable. Once the note starts, we observe the value of the stocks semi-annually against that start price. The coupon or income trigger in this note is set, as I said, at 60%. And if all the values are above the income trigger on the observation date, the coupons are going to pay out and reflect a day or two later on your trading platform. You're also going to receive an email from us a few days later to keep you up to date with the outcome of the observation. So as long as the stocks remain within the green area on the graph, your income coupons are going to flow. The autocall trigger, which is a wonderful feature, and we've got an added bonus on this one, enables the note to mature early. So although it has a maximum term of 4 years, we are actually designing for it to mature early. So this note, it goes into effect from 12 months at 100% of the start value, which is at the second observation. This means that at the first observation, you're going to receive your coupon subject to reaching the income trigger. But from the second observation, it is possible to mature early. As I said, we've enhanced the autocall feature, making it reducing autocall, dropping by 2.5% each observation from then on. So how that works is that if all the underlying stocks are at or above the autocall trigger, the note's going to mature, it's going to close out, you will receive your final coupon, and your full capital will be returned, and then you can go on to reassess your portfolio and go again. We always include the memory feature as a safeguard, just in case any of the stocks happen to dip below the income trigger. This is a fantastic feature in volatile times, and what this means is that if any of the stocks drop below that income trigger, in this case 60%, the memory feature is going to hold onto the coupon or coupons until the next time that those stocks are above an income trigger, and it'll then look back and pay out any missed coupons. If the note doesn't autocall at any of the observations and lands up running the full term, we have included a deep capital protection barrier, and that capital protection barrier is very important, and this we set at 50%. And that means that even if any of those stocks drop by up to 50% of its start price, you're still going to receive your full capital back. So if the stocks are dropped below that 50% barrier, then you're going to have your capital returned back on a one-to-one basis. So what I'm going to do now, we're going to have a quick look at a quick market cycle. The note starts, as you can see, on the left-hand side, and we're off to the races. At the first observation, you see that the line is above the coupon trigger, and your 7.6% coupon is paid out. The next observation is where the possibility of an early maturity goes live. In this example, the underlyings are below the start price, but above the income trigger, so your second coupon is paid out. The third observation, however, one of the underlyings is misbehaving and below the coupon trigger. This is where that memory feature comes in. The coupon isn't paid out, it's held in the memory feature. Moving on to the next observation, at the fourth observation, all the stocks are above the autocall trigger. The note closes out and full capital is returned. And while all the while you'll see there, the autocall trigger has been dropping as it went along. In the event of no autocall, then we'll look at the final observation. Are they above the capital protection barrier? And then your capital will be returned. This is a wonderful sheet that comes on together with the fact sheet, and it gives you exactly how you can plan and see what's happening when. So we've got the observation dates listed, and that is the date that they look at the underlying stocks, comparing them to their start value. As long as they are above the coupon trigger, in this case 60%, they will pay out your coupon. And your autocall trigger, you can see here the first observation, there isn't an opportunity to autocall, but from the second observation there is. And then the payment date is the date that the funds are released by the investment bank to your trading platform. Your trading platform will then allocate the funds, and they usually reflect a day or two later. And then, as I said before, we send you an email letting you know how that autocall went. Then at the very end, we have our 50% capital protection in the event that the note doesn't autocall. And you'll see that the last observation at observation 7 is the last observation where your autocall trigger drops down to 87.5% from the 100%. So how do you invest in a Cashbox Global structured note? If you are interested, you do need an online trading platform, which is basically a stockbroking account. We are agnostic. There are a list of platforms that hold our notes on our website, but if you do need any help, just drop in a mail through to support@cashbox.global. We will then let you know, once you've let us know that you would like to invest in the note, we will provide you with the ISIN number and the term sheet that you will use to instruct your trading platform to invest in the note on your behalf. And then from a reporting perspective, we give you those. They're not quarterly in this instance. Talk about cut and paste. They are semi-annually, where we will communicate your note's performance to you. And then the ongoing support is refresher training. We always go through a lot of information. So if you have any questions or you want to run through again, just re-explain to me how this works, not a problem. We provide investor insights on an ongoing basis. Andrew does a weekly wrap, which is really wonderful. That goes out to everybody. We do portfolio reviews of your structured notes with you, and then we obviously keep you informed of new opportunities. Closing date, again, 18th of September. We are not going to get there. The note will close out beforehand, although the strike date and the issue date remain the same, but we will be reaching capacity, so please do let us know. And with that, I'd like to open for any questions. Do we have any questions for tonight?
Joe, is a really nice one from Minesh. I think Andrew started to have a look at it. During previous market meltdown, many banks went down over 90%. We may face a recession with Trump's tariffs. Have you done sufficient research on these four banks regarding the ability to withstand some form of market meltdown? Are these banks priced well, or are they relatively expensive?
Can I jump in there, Chad, please?
Please.
Yeah, I mean, sorry to sort of take Andrew's thunder away there, but I mean, Andrew covered aspects very, very nicely there. And just to add to those points, Andrew made a big focus on the fact of the credit crunch, which occurred 2009, 2010. The banks, the European banks, have been under massive, massive pressure by regulators to do all sorts of tidying up with regards to their businesses. And as Andrew mentioned, capital tier 1 ratios was the first thing. We've had Basel directives 1, 2, and 3, which have meant that the banks have had to really make sure their liquidity is absolutely spot on with regards to their businesses. The cleansing of loans has been huge across Europe. You know, the aspect of actually some of the bad debt that was in some banks was quite shocking, really, prior to the credit crunch. So that has been enormous. I think there's a whole host of aspects which the banks have been exercising to give them the position where they are now, which, as much as Minesh's question is very valid, I don't think there's any reason at all to be troubled. I mean, yes, the banks have done extremely well. They've had a wonderful long stretch of good profits. Those profits will continue because it's demonstrable through the actions they're taking. If you look at the bricks and mortar now, the actual bricks and mortar asset portfolio within banks, they're closing branches left, right, and center. They're going down centralized hubs now where they actually share floor space between banking businesses to service clients on the high street. You know, the tech initiatives are huge. You know, the efficiencies that are being forced through there, and the investment banking arms of these banks are doing incredibly well. IPOs are up massively. Deal making is up massively. Structural hedges that the banks take to position their income flow when interest rates start falling are incredibly strong. You know, we've got the bond market that they've been investing in, coupled with the interest rate swaps that have been occurring. It's been very powerful. So the banks are really very strong, lean, mean fighting machines. And really what comes out, and the metric that really tells us this, is that the PE ratios are relatively low. If you actually, and Andrew does fantastic analysis on this, but you know, and he could probably spend another 2 hours telling us about how these PE ratios are actually the one metric that tells us that everything that I've just reeled off, the banks are doing. The banks have done a tremendous job. So great question, Minesh, but I'd be happy to delve in more with you. But no concerns, no major concerns. And I say that with the caveat that obviously, working in conjunction with Cashbox, we do put in the bells and whistles to assist with capital preservation, the reducing autocall, as an example, the deep capital preservation barrier of 50%. So it's horses for courses, but quite honestly, the rationale and the thematics and the basket that we're using, happy to stand with. Absolutely.
Great, thank you.
Yeah.
So Minesh, I've added some of Andrew's notes into the chat. A little bit higher is the rationale. Are you comfortable? Have we answered your question?
Chad, maybe I can just throw in one other comment, because it was raised by a client who phoned me this afternoon, who can't be on the webinar tonight, but decided he wanted to get involved before there was absolutely nothing left in the cupboard. And yeah, so there is a very technical document in terms of this. These are the sort of process steps, Minesh, I take when I look at a company in terms of its sector, its own vulnerabilities, its own risks, its own opportunities. But the question that was posed to me was, are the uncertainties of the US administration, let's call it Donald Trump's tariffs. What's the downside for European banks if he's imposing these tariffs, in various economic shapes? And I think what one needs to say is that tariff volatility is there. Banks won't be directly themselves impacted by Trump's tariffs, but they will be indirectly exposed via a slowdown maybe in growth in the area in which they service. So with that uncertainty, a weaker European economy would probably be negative for banks' short-term earnings, certainly, and dividends if they were producing a dividend for their investors. And that's particularly combined with imported, what I call imported deflation, which is particularly probably maybe from Chinese imports that are now being diverted from the US into Europe. That you might see, some significant impact there. However, what one needs to look at, you need to look at it holistically and comprehensively. And one of the biggest indicators, as I mentioned earlier, is the bond market. Now, for many people, the bond market is quite intricate. They're not quite sure to understand, but it's an indicator, it's the thermometer of what is actually going on. And if one looks at what's called the forward curve, the yield curve, they're not suggesting current 10-year bonds right across Europe, specifically these countries that are represented by these banks, Italian, British, and German banks. They are not showing a prolonged activity into massive ultra-low rates that we saw in 2010. So that's very important. So even if we had some tariff-induced economic weakness that hits the bank's balance sheet or earnings, the forecast by the ECB itself, the European Central Bank, is that they have forecast, and I've got the numbers, a 13% normalized return on equity. It remains unchanged. So they believe that 13% is the return on equity. So to Graham's point in terms of, yes, these banks are not quite fully priced at the moment because they're going into a space now which they haven't been, which is this mergers and acquisition, the investment banking side of things, which generates a lot of money while they trim the high street banking sort of setups and scenario, as Graham mentioned. Graham lives sort of in the United Kingdom on the Isle of Man, so he sees this on a daily basis. You go down to your bank and it's gone. It's now in a hub somewhere in London. And I think a good anecdotal, how can I call it, proof of conviction of this is what happened in April. April's when tariffs hit the world. Trump came out in front of the Rose Garden. He had those lists of every single country that had a tariff applied to it at a certain percentage. And the world went into another tailspin, There was a lot of volatility around those announcements and what's subsequently followed. But certainly, I think what's happened since then is that people have realized maybe it's a negotiation technique, maybe it's a way to certainly bring manufacturing back to the US. But increasingly, those concerns are being consigned to the past. And certainly a company like JP Morgan, if you look at the analysts in terms of the banking sector, they remain very constructive over having European banks, specific European banks, in a portfolio going forward. So to wind up my side, we are looking ahead. Yes, they've had a great run, as we've all sort of we all agree on, and we feel that there's still room to grow in the earnings balance sheets of those companies. And specifically, our contract is that we're not looking for out and out growth. We're looking for growth or even a decline in growth because we've got the step down Autocall. So we're in a very strong space. We feel we're in a very strong space. We've weatherproof pressure tested this, back testing and forward. And so that's why this product has come onto the market. Jill answered a question to an Australian investor this morning, and they said, how often do these notes come out? It was a new person to structured notes. And she says, well, we try to produce 4-6 weeks, 6 intervals. But if the market conditions aren't right, and if ourselves and our structure are not prepared to go into a product that we're not happy with, we don't have a product. We have a blip. We don't sit on the beach, unfortunately.
We have a pause.
But we put it on pause, yeah. So it has to make sense. And I think the enormous interest in this product, which has gone out of the sort of 12 to 14% into the space because of the anomaly of what happened in France. And believe you me, Graham can attest to this. the rates have moved back down to 12 or 13%. So we're very fortunate to have locked in tactically in this little window a great return with a great contract. You know, it's a typical IDAD contract with the bank, with ourselves in terms of deep protection, a great order call, superb underwriters, and a great reference. And we just timed it right, if we can call it that.
Andrew, just before we finish off, I see there's a question from Ray. I don't know if you are able to answer it. His question is crypto as a medium-term risk. I don't know how that relates to this note.
Well, I suppose crypto, you know, crypto was launched way back when. Chad, this is more your space, but well, you know, Chad is a crypto investor. He's done a lot of research and work in the space. Yeah, but crypto started as an alternative, I suppose it's originally an alternative investment currency kind of play to the dollar. And over time, it's become its own asset class, if you want to call it that. So it's regarded as an asset class and is becoming more and more regularized, you know, throughout the world with adoption and incorporation into the financial world. In terms of, you know, relative to banks, I suppose is the question relative to, is crypto going to take down banks? You know, are banks going to disappear and we're all going to go into a digital tokenized space? Chad, I don't know if you want to add something to that, but I think from my perspective, the fabric of banking just can't be unwound immediately. I think what banks are doing is they're spending a lot of time, money, and intellectual capital of incorporating with the right guidelines of digital assets into the financial system, and that's going to take some time to play out.
Right.
I think you've answered it perfectly. Crypto is fantastic. It has so many advantages. It is being adopted, but it would take a long time to displace the banks, as you say. And then, Ray, one of the wonderful things about notes is, as Andrew and Graham and whomever else is involved, we're always looking at the next year to two. We always want a product order call within that period. So, you know, over those horizons, I can't see this displacing the world's banking system. It's going to have an impact over time for sure. It is great stuff. But, you know, Ray, I think for the life of this product, we're good. I'm certainly in the banks for this one too.
Great. Well, thank you, everybody. If there are no further questions, I don't see any other questions. We're good. Thank you for this evening, and thanks for joining us. Please pop us a mail, support@cashbox.global, just to let us know if you would like us to reserve capacity for you. And as I said, we're fighting to get some more. But with that, thank you, Andrew. Thank you, Chad. Thank you, everybody. And Graham.
Thank you.
And have a great evening.
Pleasure.
Cheers, guys. Have a good one.
Take care, everybody.